welcome to Griffonomics.
Yeah, glad to be here.
I mean, imagine taking a military aircraft carrier supply chain, right?
Yeah.
A process that historically requires something like 200 grueling hours of manual human paperwork, cross-referencing, endless approvals,
Right.
and finishing that entire process in exactly 15 seconds.
It sounds completely made up.
It does. It sounds like a hypothetical pitch from a sci-fi novel. But that is a live production metric happening right now. And I think it sets the stage perfectly for what we are getting into today.
Absolutely.
Because if you're prepping for an investment meeting or you're just, fiercely curious about where enterprise AI is moving past the hype and actually rewiring the global economy, you are in the right place.
You really are.
We are giving you a shortcut to being deeply well-informed today. We're doing a deep dive into Palantir technologies.
And I've got to say, it is the absolute perfect time to unpack Palantir. The broader market noise around AI right now is it's definitely...
Well, yeah, everyone has an AI pitch deck.
Right, exactly. Every company on the planet claims to have this brilliant AI strategy, but let's be real, almost none of them have AI actually executing core business functions at scale. Palantir is the anomaly here. We really need to separate the underlying signal from all that market noise.
And that is exactly our mission for this deep dive. We're generating a granular strategic report and investment roadmap for you. We're taking a microscope to Palantir's massive Q1 2026 earnings print, their recent contract structures, and the underlying tech driving their warp speed transition into a mass-scale AI operating system.
Well, warp speed is definitely the phrase they're using, yeah.
Right. So the big question we have to answer for you today is Palantir truly the messiah of software, as the market bulls claim? Or, and this is the flip side, is this an overextended momentum mirage trading at an unsustainable premium?
It's the multi-billion-dollar question.
Exactly. So joining me to synthesize this absolute mountain of financial and technical reality is our resident expert.
Ready to get into it. And to really grasp Palantir's position in 2026, we have to, we kind of have to temporarily ignore their staggering revenue growth.
Wait, really? Ignore the revenue?
Just for a minute.
Yeah.
Because the numbers are really just a byproduct of the architecture. You have to understand why their infrastructure makes them fundamentally different from, any other enterprise data company on the market right now. They aren't really competing in the traditional data space anymore.
Right, because their entire 2026 thesis is this massive pivot away from what the industry used to just call big data. They've essentially planted their flag in the logic layer.
Exactly, the logic layer.
Let's establish that baseline for the listener. Most data giants, like your Snowflakes or Databricks, they operate what we can call the passive storage layer. They are highly efficient, highly searchable digital warehouses, but Palantir isn't trying to replace a company's data storage, are they? They sit directly on top of it.
Yeah, that's the key distinction. If you think about the enterprise data lifecycle, storing the data, that's a solved problem. We know how to do that. The unsolved problem is making that data autonomously actionable.
Right.
Palantir provides the active analytical brain that actually drives decisions across the enterprise. And the foundational core of that brain is a proprietary architecture they call the ontology.
Okay, let's unpack this, because ontology sounds like some abstract philosophy term from grad school.
Oh, for sure. It definitely does.
But it is the absolute engine of their valuation. So if a storage provider like Snowflake is the filing cabinet where you passively store all your company's records and memories, Palantir's ontology is the active central nervous system.
I love that analogy.
Right. It actually reads the files, understands the context of what those files mean to the physical business, and decides to move your arm.
What's fascinating here is how this specific architecture completely bypasses the historical graveyard of enterprise software.
The graveyard being...
I mean, for 2 decades, massive enterprise data projects have failed miserably because they generate these beautifully clean data pipelines that are entirely disconnected from operational realities.
I see.
Like a standard database knows what a row and a column is, right? But it doesn't know what a delayed shipping container actually means for a manufacturing line in Ohio.
It has no real-world context.
Exactly. The ontology fixes this. It maps data, logic, and actions into this dynamic digital twin of the entire enterprise. It basically acts as the operational body to the AI's brain.
And the timing of having this ontology fully functional right now is wild when you look at the economics of computing. I mean, AI token costs the literal price of processing a piece of data through a large language model. Those have jumped by a factor of 1,000 since 2023.
It's incredible.
It's a classic Jevons paradox.
The Jevons paradox is critical here. When commodity cognition becomes practically free, demand absolutely explodes. Every single department in a Fortune 500 company suddenly wants to wire AI into their daily workflows.
Which sounds great on paper.
Right, but for a massive corporation, that introduces a terrifying operational prospect. Complete unchecked chaos.
Because you can't just plug a generic open source AI into your ERP system. You can't have a hallucinating language model casually authorizing a purchase order for $10 million of raw titanium just because it misunderstood a conversational prompt.
Precisely. And that existential risk is exactly why Palantir's architecture emphasizes what they call the no-slop zone.
The no-slop zone.
Yeah, because the ontology maps every single logic path, permission, and action to the physical reality of the business. It provides an impenetrable governance layer.
So it's basically putting guardrails on the AI.
Very strict guardrails. It ensures a unified cost attribution and full provenance. That means you know exactly why an AI made a decision, what data it looked at to make it, and whose budget is paying for it. It forces the AI through strict security approval gates, so it doesn't cause, a catastrophic enterprise disaster.
So we have this highly governed brain and nervous system. How is it actually moving the arm in the real world? Because the industry has largely moved past simple LLM chatbots, right?
Oh, totally.
Companies don't just want a polite text response summarizing a PDF anymore. They want execution. And that is the shift into what is broadly known as Agentic AI.
Yeah, and Agentic AI represents the massive leap from generative AI to autonomous AI. We're talking about autonomous systems that can independently plan, orchestrate, and execute complex operations without human intervention.
They're not just chatting.
Exactly.
Yeah.
They don't just draft an email telling you a supply chain is broken. They literally rewrite the logistics route, secure the alternate supplier, and execute the contracts entirely on their own.
And the real-world mechanics of how this plays out are incredible. Take AIG, the insurance giant, as a prime example of this multi-agent orchestration. They aren't just using one massive AI to look at an underwriting file.
No, they deploy a swarm of specialized agents.
Right. Agent A independently ingests the complex commercial submission. Meanwhile, Agent B simultaneously pulls historical benchmarking and pricing data. And Agent C runs parallel anomaly detection to flag potential fraud.
And they all interact with each other.
Yes, they synthesize a decision and present a fully baked underwriting profile to the human broker.
It is a complete compression of operational time. And we see the exact same mechanism in heavy industry. Look at GE Aerospace.
Oh, that's a great example.
Yeah, by deploying Palantir's artificial intelligence platform, or AIP, they achieved a 26% increase in aircraft engine production.
That's massive.
Huge. And now they're pushing agentic AI across their entire military aviation supply chain. The goal is autonomous predictive maintenance and logistics to keep more aircraft physically available on the tarmac for Air Force pilots.
And that brings us back to that 15-second Navy statistic I mentioned at the top of the deep dive. Palantir deployed a system called ShipOS for the Maritime Industrial Base.
Right, the ShipOS deal.
They took the manufacturing bill of materials, the BASOM approval process, and dropped it from 200 hours to 15 seconds. Monthly material planning time fell by 94%.
It's mind-blowing.
Instead of humans sequentially emailing PDFs across 5 different naval departments waiting for sign-offs, the ShipOS agents cross-referenced the BASOM against inventorial, compliance specs, and on operational readiness instantly. But I have to push back here.
Go ahead.
We are talking about major defense contractors and load-bearing global insurance giants. Are they really just handing the steering wheel over to autonomous AI agents to run their critical supply chains?
It seems crazy, I know.
I mean, no matter how good the tech is, that sounds like a compliance nightmare and an incredibly risky leap of faith for a legacy institution.
It absolutely sounds like a massive risk, and it would be until you bring the conversation back to that no-slop zone we established earlier.
Okay, the governance layer.
Right. The ontology is the sole reason a chief financial officer, a CISO, or a military combatant commander can legally and ethically say yes to this level of autonomy. They aren't just blindly trusting some black box algorithm.
Right, they need receipts.
And they get them. Every single AI action executed by an agent is strictly governed, fully attributed, and mathematically auditable. If an agent reroutes a titanium shipment or, flags a $100 million insurance claim, there is a clear, traceable, deterministic reasoning chain that a human auditor can verify instantly.
But wait, if the ontology requires wiring directly into the absolute core operations of a Fortune 500 company, that sounds like an integration nightmare. Legacy enterprises take, like, 2 years just to approve a new cloud app, let alone an autonomous AI nervous system.
Yeah, procurement is usually a nightmare.
So if the tech is this invasive, how is Palantir actually getting these notoriously slow companies to adopt it?
That is the multi-billion-dollar question right there, and it brings us to Palantir's revolutionary sales strategy, the Bootcamp flywheel.
Well, boot camps.
Yeah, it's a complete teardown of traditional enterprise software sales. Traditionally, selling a system this complex to a legacy enterprise requires a brutal 6 to 9 month sales cycle.
Yeah.
You have endless boardroom presentations, hypothetical proofs of concept, and massive legal procurement reviews.
Oh, the bureaucracy.
Exactly. Palantir completely bypassed that by compressing the entire acquisition cycle into intensive 5-day AIP boot camps.
Here's where it gets really interesting. Because the conversion rate on these 5-day boot camps is hovering around a staggering 75%.
It's unheard of in B2B SaaS.
It is. It's the equivalent of buying a high-performance car. Instead of forcing a CEO to sit in a boardroom looking at a glossy brochure for 6 months while their procurement team argues over pricing, Palantir says, bring your messiest, most complex, unstructured, real-world data to us on Monday.
Yep, just show up with your data.
And Palantir's engineers sit down directly with the client's operators, and by Friday afternoon, they have built and deployed a live, working AI solution on the client's actual data. You get to test drive the sports car on your own daily commute. No wonder the conversion rate is 75%.
It is a strategically brilliant maneuver because it directly neutralizes Palantir's biggest actual competitor in the market.
Which is who? Other software vendors.
No, actually, it isn't other software vendors. It's a company's own internal IT department.
Oh, wow.
Yeah. Often, a CIO will say, we don't need Palantir. We can build an AI platform internally using open source tools and consultants. And then they spend 2 years and tens of millions of dollars failing to patch it together.
Right.
The 5-day bootcamp mathematically proves to the executive board that Palantir can deploy in 1 week what their internal team couldn't build in 2 years.
And this mass-scale customer acquisition engine is the direct catalyst for their current U.S. commercial surge. I mean, the financial translation of those boot camps is incredible. U.S. commercial revenue saw a 133% year-over-year surge, hitting $595 million.
That's just massive growth.
They had a 42% jump in their total customer count, and they hit a huge psychological milestone for the market. Their third consecutive quarter of over $1 billion in U.S. commercial total contract value bookings.
Which naturally bridges us directly into the broader Q1 2026 financial print. When you compress a 9-month sales cycle into 5 days at a 75% close rate, you get what is widely being described as a historic warp speed inflection point for the business.
The aggregate numbers are astronomical. Total revenue hit $1.63 billion. That's up 85% year over year.
Marking the 11th consecutive quarter of accelerating revenue growth.
Right. And U.S. revenue broadly grew 104%, officially crossing the triple-digit growth threshold. But here is the specific metric that stopped me in my tracks. Their Rule of 40 score soared 18 points to hit 145%, driven by an adjusted operating margin of 60%.
That margin is wild.
Wait, a Rule of 40 score of 145%. For the listener who isn't a Wall Street analyst, how is that mathematically possible for a software company at this scale without entirely breaking their operating model? Most elite SaaS companies throw a massive party when they just hit 50.
If we connect this to the bigger picture, it explains exactly why Wall Street is reacting the way it is. The Rule of 40 is the ultimate health metric for software companies. It's literally just the sum of your revenue growth rate plus your profit margin.
Okay.
Hitting 145% means that Palantir has essentially eliminated the traditional friction of scaling. Because the boot camps acquire customers so efficiently, their customer acquisition costs have just plummeted.
So they're spending way less to get way more.
Exactly. They are pairing the hypergrowth of an early-stage startup with the 60% operating margins of a mature monopoly. CEO Alex Karp noted that this level of extreme financial leverage puts them in an elite category previously reserved only for physical hardware and infrastructure giants, like NVIDIA, Micron, and SK Hynix.
So they're basically posting hardware monopoly economics inside a software business model.
Pretty much.
And while the commercial surge is, taking all the headlines, we cannot ignore the government side of the ledger. U.S. government revenue accelerated 84% year over year, hitting $687 million.
That government stickiness is crucial.
Oh, absolutely. This was fueled by massive awards, like a $300 million USDA contract and the rollout of the Army's Titan system. And there was also this fascinating technicality flagged by Wedbush analyst Dan Ives. He noted that a $20 million deal actually shifted from the commercial side of Palantir's books over to the government side.
That is a critical nuance to point out because it validates Palantir's core structural advantage: deeply embedded dual-use technologies.
Dual use meaning
Meaning, the exact same underlying ontology and agentic architecture that optimizes a commercial manufacturing supply chain for GE is being utilized natively for military logistics and battlefield operations for the Pentagon. They don't have to build two separate products.
But with these massive government contracts, these high-profile defense deployments, and, frankly, 60% operating margins, how does Palantir defend its territory?
Right. Everyone wants those margins.
Every other tech giant in Silicon Valley is coming for them. What is actually stopping a competitor from replicating this? Because their biggest structural moat might not be their code at all. It might actually be their geopolitics.
That is an incredibly astute way to look at it. Technically, they are fortifying their infrastructure through a sovereign AI OS partnership with NVIDIA. They are natively integrating NVIDIA's cutting-edge Blackwell Ultra hardware directly with Palantir's software architecture.
So hardware and software combined.
Yeah, this creates a turnkey, completely air-gapped AI operating system that can be deployed directly on-premises for a corporation or locally in a disconnected environment for defense clients operating out in the field.
And structurally, that ties directly into Palantir's aggressive and very public pro-Western stance. CEO Alex Karp explicitly prioritizes U.S. and allied national security above all corporate expansion. He has publicly absolutely refused to do business with adversarial nations, specifically locking Palantir out of the Chinese market.
It's a bold stance.
But purely from a business perspective, by publicly refusing to enter the Chinese market, aren't they leaving billions of dollars of commercial revenue on the table? Or is that exactly the point?
Well, they are absolutely leaving global total addressable market revenue on the table. But it is a highly calculated strategic trade-off. While locking themselves out of a massive market like China introduces some commercial friction globally, it acts as the ultimate impenetrable strategic moat domestically.
How so?
It guarantees the absolute unquestionable trust of the Pentagon, Western intelligence agencies, and highly regulated allied industries. When you're bidding to become the operational nervous system for load-bearing national security work, that absolute trust is a prerequisite that many other multinational tech companies simply cannot meet.
And the urgency for that trusted, load-bearing infrastructure is only increasing. Palantir's CTO, Shyam Sankar, recently warned about what he calls a cyber Sputnik moment.
Yeah, the vulnerability rates are terrifying.
The rate at which software vulnerabilities are being identified and exploited in this current AI arms race is skyrocketing exponentially. Rapid, autonomous remediation with absolute operational certainty isn't a luxury anymore for these institutions. It is an existential requirement.
Which loops us perfectly back to why the ontology and that governed no-slop zone are proving to be so vital. They are providing the verifiable safety net that allows these massive organizations to actually deploy the AI they're buying.
So, if we look at the board right now, we have unprecedented triple-digit commercial growth, agentic AI autonomously taking over legacy supply chains, hardware-level profit margins, and an impenetrable geopolitical defense moat.
Sound perfect, right?
It all sounds fundamentally flawless, but the stock market demands a reality check, and our job is to deliver a balanced roadmap for you. We have to address the massive risks and the intense skepticism currently surrounding Palantir's stock.
And we should, because the primary risk isn't necessarily the technology, it is the valuation realism. The market has essentially priced Palantir's stock for absolute, uninterrupted perfection.
They really have.
They are trading at a massive premium multiple, roughly a 150x price-to-earnings ratio, and 56 times their projected calendar year 2027 free cash flow.
So what does this all mean for the listener navigating this market? If the broader economy tightens up, does this 150x multiple suddenly become a trap door for investors?
This raises an important question about the hidden vulnerability of that bootcamp flywheel we praised so highly earlier.
Right, the 75% conversion rate.
Exactly. The entire U.S. commercial hypergrowth narrative is currently resting on the shoulders of that bootcamp conversion rate. But what happens if enterprise tech spending slows down?
It could stall.
If macroeconomic pressures like persistent inflation, higher interest rates, or tightening capital budgets force Fortune 500 companies to delay their software upgrades, that bootcamp conversion pipeline will bottleneck. If that 75% rate drops even slightly, the stock faces severe downside risk simply because there is zero margin for error built into the current share price.
Then you also have the inescapable law of large numbers. Sustaining 100% plus U.S. revenue growth year over year is mathematically exhilarating when you are moving from 50 million to 100 million.
Right, yeah, easy.
But it becomes mathematically grueling as your core revenue base scales from hundreds of millions into the multi-billions. Eventually, gravity always takes hold of growth percentages.
Furthermore, from a strict risk assessment standpoint, we have to look at the contractual and governance realities. Many of these massive, headline-grabbing government and commercial contracts contain standard termination for convenience clauses.
Meaning they can just cancel it.
Exactly.
Yeah.
A major customer can legally walk away if priorities shift. And structurally, the company's founders, Alex Karp, Peter Thiel, and Stephen Cohen, hold a massive 49.9% of the voting power through a dedicated voting trust.
That's a ton of control.
It effectively eliminates the ability of ordinary public shareholders to influence major corporate decisions or force strategic pivots. As an investor, you are entirely along for the ride they choose to take.
Which brings us to the final verdict of this roadmap. Weighing these genuinely incredible growth mechanics and technological breakthroughs against the undeniable gravity-defying valuation risks. Is Palantir the messiah of software or an overextended momentum mirage?
Well, if we look strictly at the operational execution mapped in the Q1 2026 report, Palantir has flawlessly transitioned enterprise AI from a generative chat novelty into an autonomous agentic execution engine.
They're actually doing it.
They are. That staggering 145% Rule of 40 score definitively justifies their current comparisons to hardware monopoly giants like NVIDIA. They have successfully built the operating system that Western enterprises are desperately buying to harness AI safely.
But that extreme premium valuation demands they never, ever take their foot off the gas. They have to execute flawlessly every single quarter just to grow into the price the market has already set for them today. It is a transformational company, but it requires an incredibly high tolerance for valuation risk.
It really does.
As we wrap up this deep dive, I want to leave you with one final provocative thought to mull over. We spent a lot of time today talking about how Palantir's ontology acts as the central nervous system, autonomously moving the arm of a single massive company. But what happens when this scales across the entire economy?
Oh, that's interesting.
If Palantir's software becomes the default operating system for most major Western supply chains, logistics networks, and defense bases, what happens when the autonomous AI agents of different competing companies start seamlessly interacting, negotiating prices, and executing binding contracts with each other entirely on their own at the speed of light?
That is a wild thought.
Risk defined, portfolio protected.